Hi, I'm doing the video on ratio analysis for my Finance 451 class, and this is basically on which company is the best to invest in. I chose two different industries and 5 companies of each, and the first one I'm going to do is IT industry, and I chose Apple, Samsung, Dell, Microsoft, and HP. There are a total of 6 criteria that I want to look into when you're determining which company is the best to invest in. The first one I'm going to talk about is earnings per share. To me, earnings per share is pretty much it's basically you know how much your return would be when you're investing in. So earnings per share could be the good guideline for that, because you want to know how much your return would be before investing in. So even though that you understand there will be a risk, that you feel a little bit more comfortable about it. So look in the chart at the very top. Apple seems to be the best bet to me. However, one thing that you should consider is that how much you're paying to buy one share. For example, Apple has the highest earning per share, but its price for one share is like about $110. In other end, if you look at the Microsoft is just a little bit over $50 for one share, and then its earnings per share is about a little bit less than $3 for last 4 years. So even though it's a lower number, that you should understand that Microsoft is about half price from the Apple's price. But considering that it's about half price, that earnings per share is a lot less than half, so you would still better out buying Apple and make the earnings per share. The next one I'm going to talk about is enterprise value, and it basically tells us what the company is worth. The bigger the company, the higher the enterprise value that it's gonna have. And I thought Apple, Samsung, and Microsoft have higher value than the others as expected, because those 3 are the main ones that are well known. I mean, of course, the Dell and HP is well known too, but Apple, Samsung, and Microsoft recently came out with all the different types of their new technology stuff. For example, Apple's doing their stuff with Apple Watch, iPad, and Samsung's doing Samsung Watch in their phones and all that stuff. And Microsoft is striving for the Surface. So it's something that Dell and HP doesn't have. So I think that for enterprise value, you want it to grow over time, because it tells the market that whatever the company has worth more every year, and that maybe because innovations that could be because of the innovations that plays a huge role in the IT industry. Next one is economic value added. It is to determine whether the firm had spent more money in the capital than what they had made. Here, if you look at the chart on the very bottom, Samsung and HP had spent more buying their capital than profits that they made for this particular year, because they have negative numbers there. Apple has extremely higher number than the others, meaning they managed to make a lot more money than what they needed to invest into their capital. So that's a good thing. To the next one I'm going to do is profit margin, return on asset, and return on equity, to analyze if a company is doing well with their business or not. People should look into these three. There are other factors that also can be used to determine that, but I chose these three because it'll tell you whether their profit is driven from a asset, equity, or leverage. And using these ratios will help you determine, let's say if you're trying to look into the companies to invest in, and there are companies like two different sizes, and one is like huge company and one is such a smaller company, and you don't know what to go with because the numbers, like in the dollar amount and their net income and everything, is so different. But then these ratios can help you because these are, as I said, ratios. So no matter what the sizes of the firms, you can compare the companies. So okay, and then looking at the profit margin here. So profit margin simply comes from net income and sales, and I use tax burden, interest burden, and operating margin rather than just picking up the net income and sales, because I want to show the closer look of it, to show you what's really driving the numbers. Just looking at the profit margin, Samsung and Dell don't look like they are making enough income from their sales compared to the others. Microsoft and HP seemed doing good, but they are not so much different from Samsung for the year of 2005. However, I think Apple seems doing just fine, even though it had dropped by a little bit in a transition from 2012 to 2013, because its numbers are still considered high compared to the others. So for return on asset, which is connection from profit margin, it's just profit margin multiplied by asset turnover is the return on asset. Some change the numbers dramatically, such as like Microsoft and HP. Their numbers dropped almost to half of their profit margins for almost every year I have compared right here. Also, Microsoft and HP were not making enough revenues from their assets because their asset turnover ratios are not even close to 1 for all 5 years I could compare. Samsung and Dell still have the lower factors than Microsoft and HP do. And Apple seems to be the one who's still doing better than any other companies being compared right here. Finally, on the return on equity, is basically leverage comes into the play. Return on equity, which leverage is multiplied to the return on asset, shows the big difference in majority of these companies. Just looking at the return on equity chart below at the bottom, it looks like Dell and Microsoft are back into the competition in choosing the best company to invest in, but it's exactly the opposite. Only reason their number got tripled or even quadrupled is that because the portion of their liability on their asset is more than the portion of the equity. Especially for Dell, their debt and equity is about 5-to-1 ratio. If you look at the number, number on the Bloomberg data, the number was like 5 point something, 6 point something. So that showed that's where I got the 5-to-1 ratio from. And looking back from 2008, also from the Bloomberg data, the portion of liability is like getting smaller and smaller, but it's still quite too much for this factor not to be the one that drives the high return on equity. Samsung and HP didn't move much, but the debt having little effect to it. Apple looks like that the leverage affected its return on equity by a huge amount, but I don't think it's like, I mean, it moved up. It did move a lot, but because it had the high profit margin and high ROA, that such a little number could make it go up a lot higher. For example, for Microsoft for the 2015, from the ROA only had like 7.04. For it to become 24.54, you had to multiply over 3 to get that high. But for Apple from 2015, it's 20.33, and for it to be like 46, I mean, all you have to do is just multiply a little bit over 2, and it'll just be that number. So considering all the factors compared to these 5 companies, Apple is the best one to invest in. There is a little concern in increasing the portion of debt in Apple, but they seem to be able to pay for it without getting into trouble. Because remember, earnings per share was high enough, enterprise value was growing up, and it made a lot more profits than they had used for their capital. And also their ROE factors were the best out of everything, even though it had a little bit of leverage. And the next one is the fast food industry. The 5 companies I'm going to compare in the fast food industries are that McDonald's, Wendy's, Popeyes, Sonic, and Chick-fil-A. To me, at first, fast food industry seemed like a big impact on our society, so it would have a really, really big market because it's like everywhere. But looking into the financial information, that it's not near like the IT industry. Even though it is a lot smaller than the other industry, I think the numbers clearly shows what's going on within the company. So I'm going to just compare the IT and food. All right, starting the earnings per share. They have been increased over the 5 years for all these 5 companies except McDonald's. McDonald's has earnings per share in 2004. It went down, but these prices can be only determined depends on their price for the share of stock. So it's not, I mean, it did go down, but it's not like the huge number went down. So I can't really say McDonald's is not the good company to invest in anymore, but we will find out going over the other criteria. The next one is enterprise value. The numbers are in big differences in between the companies due to their size. So of course the enterprise value is gonna have the different numbers too. If you look at the chart in the middle, it does have huge differences between the companies. Especially like McDonald's has over 100,000, but then Wendy's only have like 4,000 or even less than that. So, but that's why you have to consider the price for the share also, as well as the earnings per share. But when you get to the profit margin, return return on asset, return on equity. Those are the ratios, so it'll be easier when you get to that point. For the economic value added, except the Wendy's, everybody made more than what they had spent, so that's a good news. Alright, so finally for the profit margin. Profit margins for all companies seem to be fine except Wendy's. Wendy's is growing up, but I would not confidently invest in hoping for a good return because the numbers are so small. Sonic is constantly growing over the years when others going kind of back and forth, so that's a good sign for Sonic. The next one, to the return on asset. Many numbers went down, meaning they are not generating enough income from their assets. However, Popeyes and Sonic here managed to stay from the change. To the next one is return on equity. Of course, leverage played a big role here. If you see, the numbers also went to tripled and quadrupled, just like the IT industries. Sonic's return on equity here, it became 10 to 15 times higher from its ROA. So you should concern a little bit if you want to invest in with high risk or not, because even the Sonic is growing up, like growing company, but it's kind of way too much that you may lose all your investment if Sonic cannot generate enough income to pay, because creditors get the money first and then it comes to you. So if they don't have any money to pay you, then you just don't get any payment, so you lose all your investment. So there is definitely high risk there. Popeyes also has too much risk. Concerning the other factors weren't that much favorable, I think I wouldn't invest having that much of leverage either. And Chick-fil-A is just a safe one, I think, because if you don't want to take a lot of risk and you don't really want the high return taking that risk, then it's a safe play right here to go with the Chick-fil-A. After everything, after analyzing everything in the fast food industry, I think I would go with McDonald's, because I have to, if I have to choose one that it's big enough to generate the net income, they can reinvest them to grow the company, so there is a potential. And I'd say that because it's a lot bigger companies than the other ones, that even though there's a leverage, that they can manage the debt a little bit better than the other ones. And looking at the sizes, that they are not taking too much debt that they cannot afford, compared to Sonic's or Popeyes taking their leverages like that. Thus, I think I would choose McDonald's as the best company to invest in if you want to invest in the fast food industry, or if out of these 5 there might be a better one out there. But so overall, it seems like IT industry is doing better than the fast food industry, and I think it's because of the potential future. Products in the IT industry are so much more expensive, and they put more money into the market, even though quantity is kind of limited than the food. Innovation comes in such a short period of time that I think people want to satisfy themselves for their wants, so they just buy and buy and buy every time the new generation of this and that comes up. and I think some people buys their wants, spending their money over their needs. So it is definitely getting really big for the IT industry. Um, and at about the same price per share for Apple and McDonald's, because Apple was about 110 and McDonald's was a bit over 102. So their price for one share was really close to each other. But Apple has higher earnings per share, and the other factors such as enterprise value, economic value added, um, ROA especially, I would say that Apple was a lot better with all the factors than the McDonald's. So my choice between the industry will be the IT industry, and the company that I would choose out of all these 10 companies, I would invest into Apple rather than everything. Thank you for listening to my presentation. Hope it helped any of you. Thank you so much.